Most investors look at an insurance company and see a completely boring service business. They see a company that sells car policies or factory coverage, and they try to value it just like any other normal service business. Warren Buffett looks at an insurance company and sees the most powerful financial structure ever invented. It is not a service business with a float side hustle. It is a massive capital gathering machine with a service wrapper. To truly understand how this machine actually works, let's strip away the corporate complexity and picture a simple village of exactly 100 families. Every year or two, there is a small probability that one family's house will tragically burn to the ground. Rebuilding that house costs $100,000, and absolutely no single family has that kind of cash sitting in a drawer. Every household faces the exact same problem: a small probability of a catastrophe they simply cannot absorb. So, a clever villager suggests a brilliant plan. What if every single family puts $1,200 into a common pot every year? The pot collects $120,000 annually. Later that year, the unlucky family's house burns down. They take $100,000 from the pot to rebuild. Everyone is protected from total ruin, and the pot even has $20,000 left over. That is insurance in its purest form. The many pay for the few. But of course, someone has to actually run the pot. Someone has to collect the premiums, keep the accounting records, verify that the claims are real, and write the checks. That someone is the insurance company. Most normal businesses earn money in exactly one way. They sell something for more than it costs to produce. An insurance company earns money through two completely different engines. Engine number one is pure underwriting profit. They collect the premiums, pay out the claims, pay their own operating expenses, and keep whatever is left. Engine number two is investment income. Premium dollars arrive in January, but the fire might not happen until October.
On a portfolio of thousands of policies, there is always money sitting in a bank vault, waiting to be paid out someday. While that money sits there, the company gets to invest it in bonds and stocks, earning a return that belongs entirely to the shareholders. The company collects the cash, pays the claims, and keeps the difference. But how do we actually know if they are good at this? How do we keep score?
To keep score, we don't look at total revenue. We look at one single crucial number: the combined ratio. If you want to understand how a company like Progressive or Chubb actually makes money, this is the absolute only metric that matters. Insurance professionals rarely talk about absolute dollars. Instead, they measure everything using this specific ratio. The combined ratio is beautifully simple once you break it down into its three main pieces. First, you take the loss ratio, which is all the money the company actually paid out to cover claims. Second, you add the claims adjustment expenses, which are the costs of investigating and legally fighting those claims. Third, you add the operating expenses of running the business, like agent commissions, employee salaries, and massive billion-dollar advertising campaigns. Finally, you divide that entire total by the net premiums they earned for the year. The magic line for this ratio is exactly 100%. A combined ratio of 95% means that for every dollar of premium collected, the insurer paid out 95 cents in claims and expenses and kept 5 cents as pure underwriting profit. A combined ratio of 105% means they are actually losing 5 cents on every dollar of premium they write. This single metric strips away the luck of the stock market and shows you pure, unfiltered operator skill. Let's look at a real-world benchmark. Progressive, the direct-to-consumer auto insurer, runs its massive business to an explicit combined ratio target of 96%. Every single employee knows this number. If prices weaken in the broader market, Progressive will actively raise its rates and willingly lose market share rather than chase growth at a bad price that would push them over that 96% line. A company that prints combined ratios below 100% across multiple decades is doing something structurally brilliant. They have pricing discipline, brilliant actuaries, and incredibly strict expense control. On the other hand, a company bouncing wildly above and below 100% is just riding the economic cycle. But here is the absolute craziest part of the insurance business model. Even if an insurance company has a combined ratio of exactly 100%, meaning they break even and make $0 in underwriting profit, they can still generate billions in wealth for their shareholders over the long term. How is that mathematically possible? Because of a hidden superpower.
That superpower is called float. Float is the structural cash advantage that completely separates insurance from almost every other business on Earth. Think about how a traditional bank operates. A bank holds your deposited money, but they have to pay you interest for the privilege of holding it. An insurance company holds your money, but they don't pay you a single dime in interest. In a strict accounting sense, this massive pool of money belongs to the policyholders because it's being held back as a reserve to pay out for future claims. But until the exact moment that claim check actually has to be cashed, the insurance company gets to invest it. The size of this float and how long the company gets to hold it depends entirely on the type of insurance. We call this the tail. Personal auto insurance is a short tail line. Claims for fender benders are usually reported and settled in a few short months. But commercial casualty insurance, like a major liability lawsuit against a corporation or a permanent workers' compensation claim, is a long-tail line. These complex legal claims can take 5, 10, or even 20 years to fully settle. For an entire decade, that massive pile of cash just sits on the insurer's balance sheet, acting as the cheapest, safest, longest duration leverage available to any business. Now let's combine the two engines together. Think of the float as a massive loan from your policyholders. If the insurer runs at a combined ratio of exactly 100%, their underwriting breaks even, and the float is basically an interest-free loan. But if an insurer runs at a 97% combined ratio, they are earning a 3% profit on their underwriting. This means the cost of their float is literally negative 3%. Customers are actively paying the company to hold and invest billions of dollars of their money. This is the exact mathematical miracle that Warren Buffett discovered in the late 1960s when he bought National Indemnity. He used this negative cost float to build Berkshire Hathaway into a global empire, leveraging free money to buy massive stakes in Coca-Cola and Apple.
It is the ultimate compounding machine. But this massive pool of cash comes with a fatal trap. Because these companies are estimating future losses, insurance accounting is uniquely malleable. If a company gets greedy, they can use accounting tricks to hide massive losses for years. Next time, we are going to look at the dark side of the industry and how to spot a failing business before the market does.
That is exactly what we're going to uncover together here at Start With EAs. We're breaking down the market one industry at a time, applying the Buffett method to see how these companies really make their money. We are starting right here with property and casualty insurance. If you want to join us as we go ticker by ticker to separate the true compounders from the value traps, hit that subscribe button. I'll see you next time.